Now, for some people, this can come really naturally. Some people really love numbers and, get some, quite excited, and they quite feel quite confident dealing with numbers. And for some people, it's complete opposite, of that. It fills them with dread and they don't know where to start from and things like that, which is exactly why we're doing this. Because, as a business owner, at the end of the day, the buck stops with you. So yes, you can get an accountant. Yes, you can delegate this task or that task to your bookkeeper. But at the end of the day, this is still your business. So that's why we have this really important session, actually. And this whole phase is really quite important, actually, to do with viability. Because, we're trying to not overcomplicate things. And Sally's going to be leading this, in a second. So I'm going to hand this over to her, and you're in good hands there. So we're not trying to overcomplicate things for you, but what we are trying to do is give you a general awareness of basically the basic terms, business terms that you would need to know in terms of the financial aspect of your business, the basic concepts as well. And so you would feel a bit more empowered when you're actually speaking about these concepts or thinking about these concepts. And then also being aware of things like compliance, getting things in on time. When do you need to submit what and where, kind of thing. And like I say, Sally's very kindly prepped some extra resources that we made available for you earlier today. And that will live on Articulate Rise also, and you can access it through Teams. So if there's anything in the slides that maybe you're not quite sure, it's maybe not covered, maybe have a look in the extra resources to see if it can maybe expand on some concepts further in more detail, or potentially something that's actually not covered in the slides this week. We've got an interesting week as well on Saturday. So as you know, we'll have a regular Accelerator week, which is a Monday evening, a Wednesday evening, and then a Saturday session as well. And we've actually got somebody coming in from Henderson and Logie to speak with yourselves on Saturday. So that'll be really exciting to hear from an industry, someone working in the industry with regards to this sector of dealing with, startups. And then later on the afternoon on the Saturday, we'll be playing a cash flow game, which is quite an interesting way to learn about cash flow, because you're doing and you're playing a game. So again, taking that fear out of it. Okay, so I don't think there's anybody else that's waiting to be let in for now, so we'll just get going. So this session is going to be all about managing your finances. We'll kick things off with a wee bit of an icebreaker as usual, because it's been a wee while since we saw everybody. I hope everybody's doing well as well since the last time we spoke. We'll go on to finalizing phase 3. So basically wrapping up the last phase we just went through, which is adaptability. And then Sally will take over and introduce phase 4, all about the viability detail, going into the really interesting things like profit and loss account, these things you really need to know for your business, costs and income, and also then on to the break even as well. Oh, that's someone just joining, so just add them on. Sally. Okay, so we are. Yeah, I mean, it's a really good vibes, isn't it? It's all kind of, yeah, and it's a great place to be seen as well, and to be supporting them, and for them to be supporting you. So yeah, that has a really great phase. And then before we go on to the next phase as well for phase 4, and then Sally will share her screen. Okay, so just a quick reminder. So the milestone evidence to submit for phase 3, and please try and have this in by the end of March, so by Friday. I appreciate, things are a bit busy just now, especially, people thinking about mentor mashup and things like that. But just to make sure everything is tied up nicely for your next phase, going into your next phase, because that will also have milestone requirements there as well. So what you're submitting for your phase 3, which we've gone through, which you've just passed, remember we were looking at things like promotion. We had the session, Rennie came in with 2 minds and spoke with us all. So we will be looking for you to submit your branding. So we were talking about, your brand messaging with Rennie on Saturday, for example, the last session. And we were talking about things like your logo. So it's fantastic to see that people have actually submitted, or sorry to see this come through, and also the discussion on the WhatsApp group around logos as well. It's been fantastic to see everybody giving feedback on, shared logos, because it really is so insightful. You can look at a logo and think, oh, I quite like that, but then somebody else can look at it and see something that you didn't see, or spot something that you didn't spot. Or someone say, oh, I've seen something like this before. I've seen, this registered somewhere before. So all these things can save you a lot of headache later on. So definitely encourage that to continue. And then also you want to remember about your semi-final pitch. So you're thinking about working on it. So in terms of your submission for the actual pitch, it won't be due to the 17th of April, but just to show that you have some work that you've been doing towards the semi-final pitch as well. So, if you can just submit that on Articulate Rise, just using the regular forms, that would be grand. Okay, so I'm going to hand you over to Sally. So Sally, I'm going to stop sharing. And then did you want to share your screen? Oh, Adam, have you got a question?
Yes, I do. Just so you said that.
Okay, so can you see that?
Yes, we can. Yeah.
Where are we? There we go. So actually in the right place now. Okay, so phase 4. So as Aisha mentioned, there are some supporting materials for this, which you may want to have a look at in addition to the sessions that we're running. I wanted to try and keep the evening sessions fairly straightforward, relatively simple, not too many concepts. So there is some additional material in that online content that I've put together, and also is useful for reference later on as well. So it can sort of take you through beyond the program, because you may not need some of the concepts that we're looking at this week and in this phase. You may not need them immediately, and the whole sort of, is it relevant at the moment? No, I'm going to forget about it. We understand all of that, and the whole concept of cognitive overload. You don't sort of engage with things that you don't need to know. So in recognition of that, we've put together this additional material. So where's my... What we are going to look at in this session, we're going to have a think about what viability is about, thinking about profit and loss, and we'll have a look at costs and income, and then we'll finish off with thinking about break-even point. So we've seen this diagram throughout these proceedings, and we've already covered all the other phases that you can see here apart from viability. So we've thought about desirability, feasibility, and adaptability, and now bringing it all together with viability. And I think it's really important to understand, how these phases all interact. And so I'm going to remind you about two things. Way back at the beginning, I think it was possibly even in the boot camp, I asked you to think about a list of values and to think about how you would action those values in your business. And sometimes that can sit almost in conflict with some of the concepts that we're going to talk about in viability. I'll come back to that shortly. And when we did the feasibility stage, we looked at the various activities and resources and key partners that you can work with. And if you remember, I asked you to do a piece of homework where you thought about a list of things that would go in each of those boxes. And I said that we would be using them in this session. So if you have that list to hand, or if you can bring it up, we will be using it a little bit later on this evening. So if you can find it, that will save you some time recreating it. So as I said, all of these things come together. You can't deal with aspects of the business model canvas independently. You can sort of do a deep dive into each one, but if you change anything in any section, it will have a knock-on effect elsewhere. So that's just a reminder of what I've just been talking about. And also to sort of make sense of why the business model canvas is organized in the way that it is, and bringing together the concepts of viability. So the section we're looking at is the bottom line, which it was called well before the business model canvas was invented. The costs and the revenue along the bottom there. And the costs come from the feasibility section above it. As we've talked about already, activities, resources, and partners. And then your income, your revenue streams come from the desirability section, your customers above that. So there's a sort of natural flow to the way that the business model canvas works. So as it says there, we're going to be thinking about money. These sections that I've just highlighted of the business model canvas, costs and income is going to be the focus of this evening. So the really important thing for viability is that income is greater than costs. And if you can get to that position, you have got a viable business. You've got a business that's in profit. Or if you're thinking about community interest companies, it's often referred to as surplus rather than profit. If your costs, however, are greater than your income, you are in the position of having a loss or a deficit. And in terms of getting to that point of viability, there are two things you can really focus on: controlling or reducing your costs and increasing income. Simple. I can go home now, we're done. That's it. Okay. But it isn't that simple because of all the other things we've talked about. If you want to, if quality was one of your values, then driving your costs down and ignoring quality, that's a conflict with your values, and that may be a conflict with your brand as well. So you have to balance lots of other things with controlling your costs, and you need to really look at what you absolutely need in your business and what's a nice to have. And we'll come back to that a bit more as we move on. So we're going to have a think about profit or loss. I've always wondered why they call it P and L, because you can't have the two at once. It's not profit and loss, which it's always called. It's profit or loss, but that's my pedantry coming through. Always referred to as P and L. So I'm going to run through this very quickly. We will come back to this, and it's in the supporting material. In order to calculate your profit or loss, there are two stages that you go through. One is to calculate your gross profit, and one is to calculate your net profit. So when you calculate your gross profit, what you are doing is you're taking off what's called your cost of sales, all the costs that are associated with delivering your product, creating and delivering your product and service. And I'm going to flick quickly onto the next slide. Once you've calculated the gross profit, the next thing you do is calculate your net profit, and then you deduct all your overhead or fixed costs, things like buildings. And I was just noticing there, I've got depreciation on the previous slide. I don't think that should be there, but anyway, we'll come back to this slide. So you've got your profit in two stages: gross profit and net profit. And I'll come back to that in a minute. Whoops. So I just wanted to cover this item, depreciation, because it's maybe something you haven't come across before. It's not a thing that will have appeared on your list of activities and resources. When we're dealing with accounting and calculating profit and loss, what you're looking at is all the costs and income associated with a particular period of time. It's usually a year, but there can be shorter accounting periods. Often when you start, you may have a shorter accounting period, but most of the time you'll be thinking about it being a year. So you are trying to identify all of the costs associated with that period and with no other period. And one of the things that you will be experiencing at the moment is possibly buying assets, things that you need to operate in your business. And assets often last for longer than a year, longer than a single accounting period. So accountants will sort of split up the cost of an item over the period that they expect it to last for, and they will only allocate a fair annual charge for that item to the profit and loss account for that year, and that is referred to as depreciation. You also have an asset register which you keep, which is a list of all of the assets that you've bought and the stage in their life that they've got to. So every time you come to your year end and you're transferring in a slice of what's on the asset register, you will take it a piece of value off the asset register and put it into the profit and loss account. Now, I'm trying to keep that as simple as possible. I hope that was fairly straightforward. The other word that's mentioned there is amortization. So depreciation tends to refer to physical assets, whereas amortization is the word used when you're doing a very similar thing for intangible assets.
So intangible assets would be things like Graham shared with us, wouldn't it, Sally? So
yes.
Yeah.
Yeah, that's probably the one that you've come across so far. There are other ones. For example, if you were purchasing a business that already existed and on its books, it had this thing called goodwill, that's an intangible asset. So that's sort of the group of customers that they already have that they've got coming back. That's deemed as goodwill. So that's an intangible asset. So that's another one that you might come across.
Yeah.
So going back to this concept of what we want in the accounting period, there are some things that might happen at the beginning or end of the period where, in terms of cash, you have paid for something or not paid for something that belong to the year that you're looking at. So, for example, before the year, you may make what's called a prepayment. So if you have utilities is often the one that people look at, because utilities are often paid for quarterly, and that quarter might fall across your year end and the beginning of the next year. So a portion of it might belong to one year and a portion of it belongs to the next year. But you don't split up your payment, you just keep paying your utility provider. So you may already have paid in advance a portion of your utilities for that year, and that's called a prepayment, and you need to allocate that into the right set of accounts. And similarly, at the end of the accounting year, there may be some payments that you know that you're due to make, they belong to that year, but in terms of actually making the payment, you may not have made it yet. So that's termed as an accrual. You record an entry in your accounts for those things that you know that you will have to pay for that year. So those are just a couple of terms that you might want to remember so that things end up in the right accounting year. I lost my cursor. So moving on swiftly to thinking about costs. So this was the exercise that we did where we thought about operating our business, and we thought about the activities and resources and key partners. And I asked you to make a list of those things. And if you're thinking about it and you're sort of stuck to think about what are those expenses, as you develop your business, they will be the things that you can see around about you, the things that are going on that you're paying on I can see wages on there, maybe weekly or monthly basis. If you start buying paper clips for your business, to pick on a silly example, these are some of your expenses. If you're advertising, which I think is what's out the window there on that diagram, that'll be an expense. So we've been thinking about marketing and advertising. I mentioned utilities, the phone on the desk there. So anything that's going on connected to your business will be a cost of your business. And take it from me, there are always more costs than you think there are going to be. So costs tend to fall into two types. You'll already have seen this phrase maybe on that calculation of profit and loss when I've mentioned gross profit. So costs of producing the thing that you do, or providing the thing that your main product or service, these costs will be variable according to how much of that product or service you produce or provide or deliver. So we've got a list of some of these here: direct materials, production supplies. If you're paying people on a piece rate, that would be cost of sale. Or if you're paying your salespeople commission, you may be paying them in several ways. It's only the commission element that would be considered to be a variable cost. And these are the elements. So there are always exceptions to rules. And I dare say at some point you will come across an exception to this rule. But usually these are the items that go into the cost of sale and are used to calculate your gross profit. As a rule of thumb, they're things connected with the cost of producing what you do. And then your fixed costs, in order to calculate that second stage of profit, your net profit, these are things you're going to have to pay regardless of how many sales you make. So the offices that you rent, interestingly, utilities tends to come into this, even though if you produce a lot, obviously your utility bills are going to go up. But there's a fairly large chunk of your utilities bill that you're going to have to pay anyway, because there are often fixed costs associated with it. So utilities tends to come into here. Business rates, if you have to pay them, because some small businesses get relief from that. Insurance policies, salaries where these are fixed so that you're having to pay them regardless of the amount of the number of sales that you're making. And any loan interest that is fixed and tied into your loan agreements. Things like that are fixed costs. So thinking about how you control these costs and do you really need them? So the little diagram there is, if you've encountered having to buy an asset, that is a really big upfront cost. And how much are you actually using the asset? Is there a way to get access to an asset that you're not having to pay for in a big upfront cost? So can you rent it? Can you bring it in via a key partner? So either rent it from them or subcontract out a service to them so that they've got the equipment and they'll provide you with the thing that you need using their equipment rather than you having to buy the equipment. So that's a way of thinking about reducing your costs. People are often one of the largest costs that business can face. So think about, do you really need somebody to be full-time? Do you need them to be permanent? So can you bring them in on a short-term contract? Can you bring them in part-time to do the job? So thinking about that, or similarly with assets, can it be subcontracted, the activity that you want to perform? Now, there are some pros and cons with doing all of that. You might think there are some security issues around both assets and people in terms of making sure that they're available when you want them to be, but it's always a balancing act to think about costs and the security of when things are available. So there are quite a lot of conflicts in terms of thinking about cutting costs, because it would always be lovely to have everything you want all of the time, always available, always at the quality you need it to be, always the best available. we'd all like to have that, but is what's necessary for your business and what sits well with your values? You have to think about those things. And you might need to make choices between the things that you want to have at the moment and things that you absolutely must have at the moment. You might need to delay some of the activity until you can afford to purchase it. Costs can run away with you if you're not careful, and we will talk about cash flow later in the week and also at the weekend. And cash flow can be one of the biggest killers of early stage businesses. So I've talked enough. We are going to flip over to that activity that we thought about when we were doing feasibility. So if you have to hand your list of activities and resources that you created way back 2 phases ago, now what I want you to do is put a cost to those things and think about whether they're variable costs or whether they're fixed costs. And where are we in terms of time, Aisha? Have we got enough time to do 15 minutes?
Yeah, it's 6:15 just now.
Yeah, I think we should have enough time to do 15 minutes. So if you could set up breakout rooms for this activity for 15 minutes. And
Hi, is it only me?
Hi there. How are you doing?
Hi, I'm good.
Good, good, good. You just
I
joined
know I'm
us,
late,
yes, Marcin?
Yeah. I'm sorry. I'm just finished.
That's
work.
okay. You're welcome. It's all right. Good to see you. We have kind of just come back from the breakout rooms just now, so we've kind of started already, but you're more than welcome to kind of jump in. And I'll just hand over to Sally as we're talking about viability today. Okay.
so how did everybody get out, excuse me, get on in the breakout sessions? Were there any questions that came up that you want to ask now? Grant.
Just one that we had at the kind of end there, just to confirm. So in the kind of basis of you doing like the time and cost and total, is that just kind of, if you know, multiplying them together to get your total? So if you know you're doing like your fixed cost is on like a 12-month basis and you know it's £100 a month, then your total would be 1,200 or something like that.
Yeah, it was just to remind people that sometimes time costs money, as it were. That yes, that it can vary because of the time that you're using it for. So sometimes it's just a straightforward cost, you know what the cost is, but often when it's people, you have to be thinking about how much time are you bringing them in for? So how much does it cost? And,
yeah, right,
things
okay.
like that.
If you're doing hourly rates or if you're doing using freelancers or people in part-time and stuff like that. Okay, brilliant, thank you.
And often as well, people don't factor in their own time. So if you have a business, it's just so easily done. You know, Sally, if someone says, oh, do you have a profitable business? And they say, yeah, it's profitable, but they've not paid themselves or they've not actually factored in their own time because they're just doing, they get so caught up in just doing the job.
That is the burden of running a startup. You're the last one to get paid.
Last one to get paid. Craig has a question or something.
Just so like, because we're like that. So we don't pay, we just take out money when needed. We don't have like a set salary or any of that. And we make a lot of stuff ourselves. Like say we're making terrarium or I'm going out moss picking. And we try and cost that into, you know, when we're working out what we'll sell it for, but it's sort of like a made up, like, oh, like £5 or some £10 an hour kind of thing. But like sometimes when we're thinking about how we're pricing it, it's also thinking in the future there'll be so many people doing it. Is that like a good way, or should I just think what is literally if we were getting a minimum wage and base it off that, or just kind of thinking if and when we're more profitable, the way we see us eventually getting when we're over the hump, that's what we estimated would be, you know, to try and so we don't suddenly change the price of products swinging about all over the place. Is there a good way of doing it?
Well, I'm not sure that there is a good way, because I think every business struggles with this, especially at the beginning, and especially when founders are starting off. And it's something that you sort of begin to overcome in stages, because you get that realization that you're not charging enough because you're not accounting for your own time. But if you bring all of that in immediately and have to push up your prices instantly, that can be a problem. So you do need to think about it, especially, as you say, if you're going to end up expanding and having to bring in other people to do what you're doing effectively for nothing. That will push your costs up, and going to have to charge more for what you do. So it is good to try and cost in your own time properly, thinking about, you know, the research and development side of things. That's often what people end up spending a lot of time and not paying themselves for. And effectively, you're investing in the development of your business by doing that. And people sort of end up taking a view on they'll get the benefit at some point in the future when everything comes good. But in terms of thinking about your costs and getting them right for your pricing, which we're going to talk about later in the week, you really should try and attribute at least minimum pay to the things that you're doing.
Yeah.
Because if somebody else had to come in and do it, you'd have to pay them at least minimum pay.
Yeah, I think we're close to that. We've got someone helping on a subcontractor basis, which works out its own way. Yeah, and I'm like, this is the job you have to do. We've agreed the price, and if you take an hour to do it or you take 6 hours to do it, that's up to you, kind of thing. Like you've agreed.
Yeah, that's often referred to as piecework.
Okay. Yeah, I saw you mentioned that before.
Mm-hmm.
Yeah.
So people get paid for the output, the product, the end result, as opposed to being paid for the time.
Yeah. Yeah. Make it fair. Well, make it pretty fair.
Yes, it's a sort of balancing line. And obviously, if you end up working with people who are really good at what they do, maybe they will be able to produce it in less time than you can do it, because they do it all the time. And so if you think about how long it takes you, it might actually take them less. So they may be making a better pay on that than you would be doing if you were paying yourself for it.
Yeah, because they're not having to run a business at the same time.
Yeah, because they can focus on this task and get it done.
Yeah. Yeah.
Definitely.
Sorry to disrupt.
No, it's absolutely, no, it's good. It's completely about sustainability, isn't it, Sally, as well? And it is so important to build a sustainable model. So, you know, you are accounting enough for, you know, leaving some allowances for paying yourself and paying others as well. There's no point in being the loss leader. People often think, oh, I'll be the loss leader, but then they haven't, you know, you might get through a couple of months like that, but then what are you going to do when you haven't paid yourself? And, you know, so you've got to weigh things up. Stuart seems to have a question. I think we've got a hand up here, or?
Yeah, Sally, we're going to, in this session or the next one or Saturday, we're going to talk about VAT at all, because obviously, especially if you're a B2C, then that can be a kind of...
We don't really have time to talk about VAT, and most of the people here probably won't encounter VAT. There is some material on VAT in the extra pack that you've got. And do you have a particular question on VAT?
Well, it's just with my concept, it's a kind of grey area, because there's a few different online platforms like Uber and eBay and Airbnb, and the way that the VAT is charged is all different, and it's kind of complicated for what I'm kind of proposing for my business. So it would be good to speak to, I don't know, from the accountants that are coming Saturday, if there'd be somebody there I could maybe speak to on it, because it would be somewhere down the line. If you are charging over £85,000, then you want to kind of be able to get ahead of it.
If your turnover is more than £85,000, you have to register for VAT, but you can register for VAT before you get to that point. And for some businesses, there's a benefit in doing that. It really depends on how you're running your business, whether you're buying in lots of products that have got VAT on them or not, as to whether it would be beneficial to you to be registered for VAT before you have to be.
Yeah.
And there are lots of different rates of VAT. There's some material in the pack that I've put together that would be good if you had a quick look at that before. I mean, we could catch up a bit on Saturday if you want to.
Yeah, that would be good. Okay, thanks.
Okay. Any other
Yeah, and
questions?
I was just going to say on the VAT question as well, I would always recommend calling the VAT helpline, because VAT can be such a minefield. It's not just the standard 20%. So when I used to run my business, I also was VAT registered. But certain industries have certain percentages that, it's not just the standard 20%, and it can change from year to year. So I would always recommend just giving them a call. I'm actually just going to share the VAT helpline details in the chat if anybody wants to speak to them as well.
So the thing that Aisha is talking about there's a fixed rate scheme that is operated, and it's only at certain levels, and what is happening with VAT is you're netting off your inputs and your outputs, basically, and the rates that are different for different sectors are the average rate of netting off that the VAT office tend to find for that industry. And the benefit of doing this fixed rate scheme is reduced paperwork, basically. So you have to decide whether the fixed rate is beneficial to you or not. Are you typical for your sector, or are you not typical for your sector? And there's a little bit of information about that in the pack. Right, okay, if we go back to the presentation, you can find the share screen. Okay, so we're going to have a look at income. So you've probably not really thought about this, but there are different sorts of income. So there's operating revenue or income, and this is what comes from the services that you provide. But there are also other types of income that you might receive. For example, bank interest. So that is not coming from your entrepreneurial activity, that is coming from if you have cash in the bank and you're getting paid interest on it. So that is not your main area of activity. So operating revenue and non-operating revenue, just to flag up that that's a thing. And when you have been thinking about how you're going to charge for what it is that you do, as I said, we're going to talk about cash flow later in the week, and at the weekend we're going to be looking at that. The revenue model that you put in place will have a massive impact on your cash flow, because some revenue models are much more predictable than others. So if you have a more predictable revenue model, that will help you in your cash flow projections. So this first item that we've got up here is transaction revenue. Basically, what that means is every sale that you make, you get some income. And you're going to have no idea when you start out the pattern of that, because people come along and make a purchase. At the beginning, it will seem to be random. You may identify later, once you've got some figures, you may identify patterns. You may find that there are seasonal highs and lows. You may find that particular events cause people to make transactions more than at other times. But right at the beginning, you'll find that quite random. You haven't got a contract. People are just going to turn up and make a purchase. Whereas if you have got a service agreement in place, if you've got a contract with somebody and you know when your regular payments are going to be, that is a much more predictable way of receiving income, and will help you greatly in terms of making your cash flow projections. Project revenue is another thing you might want to think about. If it isn't a small one-off purchase that we've got at the top there, if you are in a long-term project, you might want to see if you can have built into that project some stage payments, so that you don't have to wait until the end of the project where you've completely delivered everything before you get any money. Because sure as anything, you'll have costs along the way. The costs won't wait till the end. So if you can, if you're on a large project, you want to negotiate milestone payments with your customer. And recurring revenues, obviously, that again is good for predicting cash flow. So I'm going to move on from that because that, I think, gives you a flavor of that. And then there are all sorts of other types of finance, which, so this is cash that you can bring into the business, which is not coming from the activities that you are selling. So you may already have put in some founder capital. You may already have hit up your family for some investment or a loan. You may think about bank loans. You may be fortunate enough to bring in an angel investor at some point. I don't know if we're planning on doing anything on crowdfunding, but that again is a potential source of investment, so capital coming into the business. So there are lots of ways of bringing in capital into the business that is not about making sales. And at the stage of business that you're at, early doors, all of these potential sources of income are really important because they create for you what we refer to as a cash runway. So this concept of a cash runway is the money that you've got before it runs out, i.e., how long have you got for your business to get going? During this phase, you will often see, if you're looking at your cash flow, money going out. You may have managed to bring in some money, for example, the £2,000 that is associated with this program. You may have brought that in, but once it's gone, it's gone. So where is the next runway of money going to come from until you can actually start making some sales? So as I mentioned earlier, cash flow problems are one of the biggest killers of small businesses and startup businesses. Even businesses that on paper, when they come to do the accounts, they're making a profit, can be put out of business by having cash flow issues. So profit doesn't necessarily mean that you'll be successful. It doesn't necessarily mean that you'll be able to sustain the business. Cash flow is really king, which is why we're going to spend quite a bit of time on this on Saturday. So I wanted to introduce to you maybe a slightly strange concept. This comes up in the press quite a bit. The idea that businesses can be operating on a long-term basis at a loss. And I wanted to put to you some reasons why this is happening. Basically, those businesses are investing in growth in some way, either the initial purchase of assets that you probably are thinking about in terms of starting up your business. And we've got two types of scaling up mentioned here: purposeful reinvestment, which is when a business has definitely got to the stage of it could potentially be showing a profit, but what it decides to do is reinvest that money back into the business. So instead of taking out dividends or distributing money to shareholders, that money is going back into the business so that it can be invested in growth. And some people, some businesses, they pursue what is often called hopeful expansion. So they're doing a similar thing, but they may not have actually got to the stage of creating profit. So they're funding this either through bank loans or angel investment or crowdfunding, some of the things that I mentioned on the previous slide. So growth requires money, whether it's right at the beginning when you're starting from nothing or whether you're at the scale up stage. You're going to need some cash from somewhere, and if you can manage it based on sales, that type of growth is called organic, but not a lot of companies manage to do that. So we are going to have a think about how much money have you got? What is your cash runway? How long are you going? Have you got to get going with the resources that you've got in terms of the cash that you've got available? And interesting, I can see Craig at the bottom of the screen at the moment on the right hand side, and his question sort of feeds into this, because another way of creating runway for yourself is not to pay yourself. But if that is what you're doing, how are you eating and how are you paying the mortgage? So you may not actually have put the cash into the business. You may have savings which you're funding your life outside the business through, but in a sense, that's also part of this cash runway. Because if you're not paying yourself, somebody's paying, somehow you're having to pay for your living expenses. And I'd like you also to have a think about your revenue model and how predictable that income stream is. Both of these things will come into play when we're thinking about cash flow models. So I think we're probably thinking maybe about 10 minutes for this breakout.
Yeah, definitely. Okay, we're good to go. All right, guys, if you just join, that's the breakout rooms now open. Kirsty, I'm just going to add you to, do you remember which one you were in before, Kirsty?
2.
2? Yeah, okay. Are you back in? There we go. I think everybody else is sorted.
Sorry, we both went for it at the same time there. Right, let's share. Okay, so the last thing we're going to have a look at today is this thing called break even. So break even is where you haven't got a profit and you haven't got a loss. You're just covering the costs that you have. And you may think that this is not an especially exciting place to get to because you want to get to profit, but this is better than being in a loss position. And also understanding how many sales you need to make to cover all of your fixed overhead costs is a really important thing to sort of build into your model in terms of when we come to think about pricing on Wednesday. So break even, lovely diagram here, and a formula down at the bottom, which I can't read because it's hidden by all of the other things on my screen. But the break even point is your fixed costs, your overhead, divided by your selling price. So you do need to have some idea of a ballpark price that you're going to sell things at. You may tweak that later and you may change it completely once we've had our chat about pricing on Wednesday. But if you give yourself a figure there, less the cost of the items that you're going to sell. So in the example there, actually, I can't read it because it's all hidden up. Aisha, can you read that?
I can read I think a part of it, I can see the bit that says break-even point equals fixed costs, and
So,
then it's
so if we're having trouble, is everybody else seeing what's on the screen here? Yeah.
yeah,
I can see it, yeah.
yeah, I can see it.
Lewis, do you want to read it for us then?
Oh, yeah, okay. Just the whole thing.
No, just that bit at the bottom in the
Yeah, of course. Sorry.
yeah, because
Yeah.
I can't read that.
Okay, so the break-even point equals the fixed cost or the overhead over the selling price per unit minus the cost per unit. And then so the example says 8,000 over 20 minus 10 gives you 800 units per to break even.
Okay, so hopefully everybody understands that. So we were talking about fixed costs earlier. So things like your rent and salaries, all the things that you are going to be faced with paying, whether you make any sales or not. So in this example, that's that £8,000. And so in this business, they've decided that they are selling their product for £20, and they've calculated that the costs of each of those products are £10. So the profit in each of them is £10, but they've got all of these overheads to cover before they can actually make a profit. So if you want to think about the difference between gross profit that we talked about earlier and net profit, so the gross profit is the £20 less the £10, so that's £10 per item. So if we were selling 800 of these things, we would have a gross profit of £8,000 if my maths works well. But actually, because you then have to deduct your fixed costs, which is the second stage of that profit calculation to get to your net profit, you've got these £8,000 of fixed costs, and that would take you down to zero, which is your break-even point. Does that make sense to everybody? Hopefully. So I think that we're going to go straight into the next breakout, which hopefully you've got some idea of your costs from the exercise that we did earlier. And if you might have some idea of what your selling price is going to be, we're going to give you 10 minutes to have a go at thinking about your break-even point. How many units are you going to have to sell in order to get to break even? And you may not achieve all of that in the next 10 minutes. You may just have a good chat about it with some of your colleagues. But I would urge you, after we've finished, to have a think about this calculation, because it is going to be good for you to understand how many sales you need to make to cover your costs. So are you ready for the breakout?
Yes, I'm ready. So another 10 minutes or 10 minutes, okay? All right.
10
Okay,
minutes, and then we should have time for some questions and time to wrap up.
Okay, Grant. Okay, so that's the breakout rooms open now, folks. If you just accept, that'll be great. Thank you.
So we're kind of just speaking about how it's to know your own business and to know your own customers, to know if you need to streamline it to a specific few. So if you know you only need 5 sales a month, you don't need to cast such a wide net to try and get a huge audience in. You only need those specific 5 to purchase. So the example I used was hi-fi systems, especially like Holborn Hi-Fi, which is kind of in the middle of Holborn Street. You never see anyone in there, but it has remained open for years and years. The whole time I was at uni, and then every time I've driven past, it's still there. But you look in the window and they're selling systems for kind of tiny little speakers, and they're $6,000 and things like that. So you know there must be people coming in and buying it, but they only need to sell a few items per month, and then they break even and likely make money off of it. So they're really focusing on that targeted few, that 5 individuals that they need to buy every month, rather than trying to go for the mass market, which isn't, which wouldn't be viable, because they know the wider market couldn't afford these speakers. They're going for enthusiasts and things like that.
Well, I thought that was a great example of what we were talking about. So any questions coming out of any of the other groups? No burning questions. Okay, well, that obviously means I've done a stellar job for the evening. We've covered everything. It's totally comprehensible.
Yeah.
So I will look forward to seeing you on Wednesday evening when we are going to talk about pricing. And we're also going to be thinking about accounts in their various forms. So have you anything to wrap up this evening, Aisha?
No, it was just so there's no other slides to share, anything like that, is there? No, for the next session and things like that?
No, I guess the learning outcomes would be the last thing to share, but you can have a look at those later when you get the slides.
Yeah, okie dokie. Well, that was a great session. I mean, if anyone has any questions, like I say, some of these concepts may seem, maybe out of people's comfort zones. Completely appreciate that, and don't forget the extra resources are on Articulate Rise to help with that as well. I did ask, somebody was asking me early in one of the breakout rooms about accountants and things like that, and of course we can refer people on to you. But just to say, I wouldn't rush straight away to go and get an accountant, and this is why we're hosting this session, so you have an understanding of these terms, at least yourself. Previously, when I used to be a business advisor, I would see people start a business and then just go straight away get an accountant, and then you're throwing a couple of grand away on an accountant that you don't really need at that point in your business, because sometimes you can actually self-file, or your business isn't quite trading at that level just yet, so I would always advise you sort of proceed with caution, and make sure it's a right fit as well, not to rush straight away to getting an accountant, because the cash flow, it is really important to keep your cash going, and you don't want to take that chunk of money you could be spending on stock or whatnot or other equipment and put in an accountant just to kind of ease that worry in your mind, but then find out that you didn't actually need to do that. And a lot of it, you can actually look into, yourself as well, just to get that basic understanding. So I think that would be my kind of main tips to kind of take away.
And we're going to cover this to a certain extent on Wednesday. There is a difference between compliance, which is preparing the accounts that you need after the event, and management accounting, which is preparing figures for you to look at during the year, so that you know what's going on, so that you can see what your cash position is, you can see what sales you've got coming in, and you can actually make decisions along the way to promote things or whatever's required, so that you can actually change the outcome. When you get to the stage of compliance accounting, you can't change anything. It's all done by that point. You've finished your year, it's happened, it's just a fact. But management accounting is for your benefit, so that you can take actions in your business. And if I get across to you anything this week, it is this thing of understanding the numbers during the year so that you can take action. Accountants can deal with the figures after the event and prepare your accounts and file your tax returns. That's all relatively boring. The interesting stuff is what's happening in your business during the year.
Definitely. And people were saying to make use of things like, accounting softwares, that could be an option. Things like QuickBooks has been mentioned this evening as well. So potentially, that's something to look into. I mean, of course, there's different options. I'm not saying to go out and get QuickBooks, but
yes, there
are ways to help. Yes, as well.
Things have come on so much, with mobile phones and these packages. Actually, doing the financial paperwork can be so much easier than it used to be, and those systems will help you prepare some of these figures that we're talking about in a way that had to be done manually previously, and so you can actually have a lot more information available to you a lot more quickly and a lot less painfully than used to be the case.
Definitely. Okay, well, thank you so much, everybody. Finishing a little bit earlier today, so just a couple of minutes to go extra. we will see you all on Wednesday evening for another session. So have a lovely couple of days. Bye, Stuart. Lovely waves.
you.
Bye, everybody.
Thank
Bye,
you.
Fido.
Thank
See you
you.
next
you.
time.